Aprila Bank.
And I'm Kjetil Barli, CFO of Aprila Bank.
We are extremely excited to welcome you to Aprila Bank's Q2 presentation. We will present some forward-looking statements today. They are based on what we're aware of as of now and our expectations on how things like Norway's economy and interest rate will evolve going forward. But even though we have very strong predictive models in the form of our machine learning algorithms, we have not yet developed a crystal ball to tell us exactly what the future will look like. I'll start by giving the highlights of the quarter. Kjetil will present the financials in more detail and with a slightly updated format. I'll present our priorities and outlook going forward, and finally, we'll take your questions. The chat function on this webcast is disabled, so please send your questions on mail to the email address on the screen, and we'll address them towards the end. As usual, a quick recap. Aprila Bank is a digital bank providing credit to small and medium-sized businesses, so far only in Norway. What makes us distinctive is our continued technology development to, one, use ever-improving machine learning algorithms to predict the risk of individual businesses so that we can offer limit and price in real time, and automate everything that can and should be automated to reduce costs to serve our customers. At the end of Q2, we had 5,521 lending customers. Of these, 30 were landlords from a home rental factoring pilot we did together with Schibsted, but the remaining 5,491 are small and medium-sized businesses. And 98% of these are small businesses with 20 employees or less. But we are experiencing increased demand from medium-sized businesses, which now accounts for 2% of our customer base. In total, we added 428 customers in the quarter and had a churn of 251. The majority of the churn was due to the introduction of monthly fees for all credit line customers, 249 kroner. However, the P&L contribution from this was positive, as I'll get back to later. A big milestone during the second quarter was that our gross income run rate surpassed 100 million kroner with a good margin. From this, we have to subtract direct variable costs, such as commissions to partners, interest rates to our saving customers. But even after this, we achieved a gross margin of 84%, which is a new record for Aprila. And last but not least, according to our customers, so far we have contributed to creating or saving 2,500 jobs since the start of Aprila. But the biggest milestone in the second quarter was that we are finally profitable. And what a timing! In a market environment with significant uncertainty, skyrocketing inflation and interest rates, and valuations of unprofitable growth companies being hammered, we've gone from burning equity to creating return on equity. The net result for the quarter was plus 1.6 million kroner. And our gross profit margin improved from 80 to 84%, and our operating expenses compared to the same quarter last year actually reduced by 1.1 million. And the strong growth continues. Gross lending grew by 18% in the quarter, gross income by 22% in the quarter, and most importantly, total income, which is what we live off, jumped by 28%. In total, we're still growing at an annual rate around 100%. And we are sufficiently capitalized for continued strong growth. We raised 60 million in the quarter and improved our equity positions even more with a 1.6 positive result in the quarter. It is such a relief to be done with fundraising so that we now can focus 100% on profitable growth going forward. As I mentioned, total income is our most important revenue metric. It is gross revenues, less interest we pay on deposits and direct variable costs, such as commissions to partners. Total income jumped from 18 to 23 million kroner in the second quarter, which is the biggest quarterly increase ever and the biggest percentage growth in 5 quarters. And the growth is, of course, coming from our hit product credit line. Total income from credit line has tripled over the last 12 months from 6 million in Q2 last year to 18 million this quarter. Originally, we planned for Visma to take over our spot factoring customers during the second quarter. However, we will continue with spot factoring for the time being, and we are in discussions with Visma as to if or when the spot factoring will be discontinued. Customer growth is still the most important growth driver of credit line, but contribution from average income per customer is increasing. There are two reasons for this. As I mentioned, in June, we introduced monthly fees of 249 kroner for all customers, all credit line customers. Before this, a substantial share of our customers were not paying fees at all, only interest rate. This resulted in significant churn among the small customers that had never drawn up the credit line, and that really resulted in an increase in average customer revenue for the remaining customers. The net P&L impact was very attractive because we had to make loan loss provisions even for the customers that were not using credit line. So the introduction of fees for all reduced our loan loss provisions and increased our revenues. The other reason is that we're seeing increasing application volumes from medium-sized companies requesting large credit lines from 1 million and up. We have not deliberately been targeting this segment, but now that they're starting to show up, they are of course very welcome. These customers typically have lower risk and significantly higher lifetime value. As a result, we're increasing focus on adapting the product to attract these kind of customers going forward. There are about 30,000 medium-sized businesses in Norway, and the majority of these are also underserved by traditional banks. The big drop in cost from Q1 to Q2 is primarily because we don't have salary expenses in June, but also because we relaxed our marketing investments a bit in Q2 to ensure that we would actually be profitable in Q2 as promised. In Q3 and Q4, our quarterly costs will be back around 18 million. But the big picture that this graph illustrates is the scalability of our business model. Due to the constant expenditures on technology development to improve our products and reduce variable costs, our fixed costs are a very big share of our total cost base, around 60 million per year. But our variable costs are low and declining, and our gross profit margin is very high compared to other banks and other companies in general. This means that as we continue to grow, we'll become very profitable over time and be able to deliver a much higher return on equity than what is possible for a traditional bank. Our realized losses are stable around 500,000 per quarter, but in Q2 we had to increase our loan loss provisions with 7.8 million due to three reasons. Reason number one was that share of late payments from customers increased from around 7% to 8% in the quarter, possibly due to more challenging market conditions for small businesses in Norway. The second reason is that we increased our lending balance with 76 million, of which we have to take approximately 3% loan loss provisions to cover potential future losses, corresponding to 2.3 million kroner in new loan loss provisions. And finally, third reason, one-off changes in our IFRS 9 model resulted in about 1.7 million in loan loss provision increase. Nevertheless, we had to book this against our earnings together with realized losses. 1.5 million kroner corresponds to 32% of our gross income, which is higher than our target of losses being less than 25% of gross revenues, and it is much higher compared to traditional banks where losses are typically less than 10% of gross income from lending. But what drives return on equity is the absolute return on assets that your business model achieves. Net interest rate margin measures the return on lending capital after interest rate costs and commissions to partners. Traditional banks have net interest margins of 2 to 4% before losses. We have a net interest rate margin of 14% after losses. This is equivalent to being able to borrow money at 0%, and invest risk-free at the rate of 14%. And we can invest, i.e. lend, approximately 5 times our equity, meaning we can achieve a 70% return on equity before internal costs. To compare, 20% return on equity is in practice a fixed ceiling for most banks, and very few banks, or other companies for that matter, are able to return 12% return on equity over time. I believe that we eventually will be able to deliver consistently over 30% return on equity due to this business model. And in the second quarter, we increased our equity with 62 million kroner, around 60 million in new equity, and a plus 1.6 million from the positive net profit in Q2. So what does this mean in practice, Kjetil?
Well, following the equity issues completed in the second quarter, the bank had a CET1 ratio of 41.3% at the end of June, which is more than 2 times the capital requirement. All else being equal, this means that our loan book could have been more than twice the size today, and the bank would still be sufficiently capitalized. The capital requirement will increase by 2.5 percentage points over the next 3 quarters, reaching 21.5% by the end of March 2023. And these are currently known changes which apply to the majority of Norwegian banks. During the fall, we expect FSA to determine a revised Pillar 2 requirement for Aprila. The current requirement of 4% was originally issued as a so-called startup buffer when Aprila's banking license was granted almost 5 years ago. Now, let's look at our key figures for the second quarter. It finally makes sense to start using traditional performance measures for banks, such as cost income and return on equity. So, from this quarter and onwards, we will report these 6 figures on the first slide of this section of our quarterly presentations. Starting with unique customers, upper left, we had 5,521 unique customers at the end of the second quarter, up from 5,344 at the end of the first quarter. As mentioned by Halvor, this is a weaker customer growth than we have experienced historically, and there are 2 reasons for this. 1, we spent less on marketing, and 2, we introduced a monthly fee for all credit line customers, and this resulted in a high but intended and profitable churn. Moving on to gross lending, this number increased by 18% in the quarter, from 438 million to 517. The growth in gross lending, combined with increased interest and fee income, resulted in a total income of 22.9 million NOK. Up from 17.9 million in Q1, an increase of 28%, as Halvor mentioned earlier. Cost income, lower left chart, came in at 56%. Operating expenses in the second quarter are, as Halvor mentioned, lower than normal, with only 2 months of ordinary salary expenses. With full salary payment in the quarter, the cost-income ratio would have been 70%. Still a strong improvement from Q1. Next chart, loan losses, measured in percent of gross loans and annualized, came in at 7%, up from 5.2% in Q1. And finally, profit after tax came in at 1.6 million, equivalent to an annualized return on equity of 5%. Taking a closer look at the credit line product, we added net 210 accounts in the quarter and had close to 2,900 open credit line accounts at the end of the quarter. 84% of the customer accounts had utilized the credit line at the end of the quarter. The average balance per account has continued its positive trend and reached 157,000 at the end of the quarter, and the 84% share of our customers that had a drawdown at the end of the quarter had an average balance of 187,000. Moving on to spot factoring, we purchased invoices with a total nominal value of 159 million NOK in Q2. Spot factoring accounted for 24% of gross income in the quarter. Our average margin was 3.8%. Services, retail, and construction industries accounted for close to 80% of the purchase invoices. And at the end of the quarter, we had 3,301 open spot factoring accounts, of which 71% had used the product by the end of the quarter. We stopped onboarding of new spot factoring accounts from Visma early February, so the growth in new accounts has now turned negative due to churn. In terms of the future of this product, as Halvor mentioned, we will continue with spot factoring for the time being, and we are in discussions with Visma as to if or when the offering will be discontinued. Loan losses in Q2 came in at 8.4 million, 7.8 million in loan loss provisions, and 0.6 million in realized losses. 1.7 million of the loan loss provisions were related to a one-off. Without this one-off, the ratio of loan losses to gross income would have been in line with our long-term ambition of 25%. Looking at days past due in the upper right chart, DPD 31+ increased by 1.2 percentage points. The main driver behind this was exposures that are 91 days or more past due. This is an expected development, and the trend will continue until we start offloading our NPL portfolio. We are in discussions with potential buyers and will consider to complete our first NPL sale this fall. Finally, loan loss allowances in percent of gross loans were 7.3% at the end of the quarter, compared to 6.7% at the end of the last quarter. So that was the most important figures from the second quarter. So I'll give the stage back to you now, Halvor.
Thank you, Kjetil. For the second half of 2022, we have the same priorities as for the first half, but we have reversed the order. The top priority now is to maintain a high growth trajectory so that we can really start capitalizing on the outstanding capital economics of our business model. The second priority is to strengthen competitive advantage. This is important because we believe there will be more competitors in this space once others start realizing how attractive this segment is when you do it in the way we do it. And last but not least, we want to keep improving the unit and capital economics of our business model even further. On the first priority, we are evolving our credit line product to be more relevant for medium-sized businesses. We continue to optimize offers to increase growth while keeping marginal interest margin after losses high. And we still see a big potential to unlock demand by using marketing and communication to spread knowledge of our offering to the 500,000 underserved small and medium-sized businesses in Norway. On the second priority, we continue to create an even more seamless and gratifying customer experience to increase attractiveness and retention. Our offerings should not only be useful, but delightful to use. Our PD model, that is probability of default model, is continuously learning and improving every month as our volume of observed business outcomes grow exponentially. And we now have sufficient volumes of collection cases to start applying the same machine learning technology to our LGD model, loss given default. And we have finally collected enough PSD2 data that we can actively start incorporating this into our PD model. On the third priority, we continue to optimize our pricing models to improve the rate and return of successful customer applications. And we continue to reduce cost to serve by automating servicing and monitoring of customers, as well as reporting and compliance activities. When it comes to our guiding going forward, we still believe that our gross income run rate will surpass 150 million during the year, driven by credit line. We expect gross margin to remain very high and hopefully increase even further from today's level. But we no longer expect to have more than 4,500 credit line customers at the end of the year. There are two reasons for this. Reason number one is we now see that high customer growth impacts short-term profitability even more than we had previously thought, both in terms of marketing costs and in terms of loan loss provisions, which both have to be taken up front, whereas customer revenue accrue over time. The second reason is that, as I mentioned earlier, we see a surprising amount of interest for larger loans from medium-sized businesses. As a result of this, we are diverting some of our growth focus to target this segment more accurately, both in terms of product development and in terms of marketing. This reduces the gross number of customers, but increases balance, income, and profitability per customer, so that overall gross income and profitability remain stable. In terms of growth and profitability for the rest of the year, we're trying to balance these obviously conflicting priorities so that we're targeting around 0 in net result, both for Q3 and for Q4. This concludes our presentation, and we're now ready to take your questions. And here's the email address for the question. Do we have any questions, Kjetil?
No questions yet.
So everything was crystal clear?
Yeah, it looks like it.
One question that I've gotten already is how it's looking after the second quarter. And the answer to that is obviously July was a bit soft, like usual. However, we received almost twice as many applications and customers in July this year compared to July last year. And already this far in August, we're seeing application volumes back to the normal level from earlier this year. So looks like the growth is continuing on the same track.
We have started to get some questions now. So let's start with the first one from Herman Saal in Pareto. Could you talk a bit more about what type of SME customers you're looking to attract?
So our focus has always been and will continue to be small businesses with less than 21 employees and less than 20 million kroner in revenues. And as I said, these are 98% of our customers. They're extremely underserved by traditional banks. But we are now also starting to focus on the medium-sized customers with between 20 and 100 million kroner in revenues. In terms of industries, we are and geographies, we are completely agnostic as long as it's Norway. We have customers from every industry and every municipality in Norway, and actually surprisingly identical distribution of our customers compared to the overall customer or small and medium-sized business distribution in Norway. So that's our focus. Small and medium-sized businesses in Norway across all industries.
Very good. So we have more questions. This one is from Jack Fransen. The question is why only 2 salaries in Q2? And the reason for that is that June is holiday pay. And that expense is booked in the 11 other months. So then it's only 2 months of salary in Q2. Next question is from Adil Osmani. He says, medium-sized customers, any elaboration on size of interest, etc.? I think he's thinking about the somewhat larger segment.
Yeah. So our our interest rates are in general from 10% to 30% per year, depending on the risk level. However, for the larger loans and medium-sized businesses, they are typically much closer to the 10%, and the least risky of these businesses with very solid equity and profitability positions and good track record get 10% in interest approximately.
It might also be that he's asking about the typical size of which part of this segment that we would be targeting.
Yeah, so we are in principle seeing interest in the whole range from 20 million to 100 million in revenues. However, the majority of medium-sized businesses have between 20 and 50 million in revenue. So that's, if you want to ask for a focus, that's, I guess, our focus. And in terms of size of loans, the typical loan size in this segment is from 2 to 5 million kroner.
He also asks about any guesstimates on what this business could represent. I guess he's thinking about market size or...
Yeah. Okay, let me try to do a quick guesstimate. So there are about 30,000 such businesses in Norway. I would say the potential is for us maybe to get in the long term, over many years, maybe get a third of that market in the very best case, so 10,000. Average loan size maybe 3 million. So that's 30 billion, is it? Yeah. But that's a very rough and probably a little bit optimistic estimate.
Okay, his last question is any interesting plans for going abroad? At least that's my interpretation of his question. So do we have any plans for going abroad?
Not in the near to medium term. We obviously think that's the sort of natural and logical next step once we have captured the full or a large part of the potential in Norway. However, we are so far away of capturing the full potential for our business model in Norway. So the next 3 years is going to be full focus on Norway. And that also means that in terms of how to expand internationally, to do that as a technology provider to large banks or to open up digital branches in other countries, passporting our banking license, we have not yet decided.
Very good. We have one more question from another one from Herman Sahl in Pareto. How should we think about costs going forward beyond Q4 22?
Beyond Q4. So as I mentioned, our fixed costs are relatively stable, and they will primarily grow with salary inflation. Whereas our variable costs are around 1,000 kroner per customer per year. So I guess that answers the question. It very much depends on our customer growth going forward. Do you remember approximately what we expect our total cost level to increase?
Well, we could say that in terms of salaries are our biggest fixed cost. And at the end of this year, we will be 29 employees in Aprila. And in our business plan, the number of FTEs tops out at 35. So I think that should be a good guiding for where our fixed expenses are heading.
Yeah.
So 29 FTEs at the end of this year, and then gradually up to 35 a couple of years from now.
Yeah, plus salary inflation.
Very good. I think that was all the questions.
Thank you all. Thank you for your time and showing up and asking good questions. And we wish you an amazing weekend. Thank you.
Thank you.